Today we talk about why big companies pretend to compete. They tell us markets are competitive. They tell us choice protects us. They tell us if prices go up, it's because of supply and demand. But look closer. Why do prices rise together even when companies swear they're rivals? Why do different brands feel suspiciously similar? And why does it feel like no matter where you go, you still lose? This isn't an accident, and it isn't a conspiracy either. It's something far more subtle, something legal, quiet, and incredibly profitable. Big companies don't always compete. Sometimes they pretend to. And once you see how it works, you can't unsee it. Pause for a second. Think about airlines, or banks, or phone companies, or food brands at the supermarket. Different logos, different ads, but the same prices, the same fees, the same frustrations. You're told competition exists, but your wallet says otherwise. So what's really going on? To understand this, we need to forget the simple story we're taught. The story that says companies are constantly fighting, that every business wants to beat the others, that lower prices are always the goal. Because in the real world, competition is expensive, very expensive. Price wars destroy profits. Innovation costs money. Uncertainty scares investors, and instability gets CEOs fired. So over time, the smartest companies learn something important. Winning isn't about beating rivals, it's about avoiding battles altogether. Let's rewind. In basic economics, competition is supposed to look like this. More companies enter a market. They fight for customers. Prices fall. Quality improves. Consumers win. That's the theory. But theory assumes something unrealistic. It assumes companies are willing to suffer. In reality, companies hate pain. They don't like unpredictable profits. They don't like aggressive rivals. They don't like chaos. Investors don't like it either. If a company suddenly cuts prices, its stock usually drops. Why? Because Wall Street doesn't reward cheap prices. It rewards stability, predictable revenue, reliable margins. So executives are given a clear message: don't rock the boat. And slowly, markets start to change. The number of competitors shrinks. Mergers happen. Smaller players disappear. And the few survivors learn to coexist. Not by talking to each other, not by signing secret agreements, but by watching. One company raises prices. The others wait. Then quietly follow. No emails, no meetings, no evidence, just observation. Economists have a name for this: tacit collusion. It sounds complicated, but the idea is simple. Everyone understands the rules without anyone saying them out loud. Think about a crowded elevator. Nobody announces personal space rules, yet everyone knows where to stand. Markets work the same way. When companies are big enough, they don't need to communicate. They just react. And the reactions are predictable. Let's look at a real example. Airlines. Every airline complains about thin margins. They claim they can't lower prices. They say fuel costs are too high. Labor is expensive. Planes are costly. Yet somehow, fees rise together. Checked baggage fees, seat selection fees, change fees. One airline introduces a new charge. Within months, everyone else copies it. Not because they were told to, but because not copying would hurt them. If one airline keeps prices low, they attract more customers. Sounds good, right? Except it forces others to respond, and suddenly everyone is making less money. That airline becomes the villain. So instead, everyone quietly agrees through behavior. No one starts the fight. No one breaks the pattern. Now let's talk about banks. Why do overdraft fees look the same everywhere? Why do interest rates move together? Why do free accounts disappear at the same time? Again, not coordination, just shared incentives. Banks know customers rarely switch. They know people hate paperwork. They know frustration doesn't equal action. So why compete aggressively? It's safer to match each other. And when everyone matches, customers have nowhere to run. Telecom companies do the same thing. Phone plans change together. Limits increase together. Prices rise together. And when one company removes an unpopular feature, others soon follow. This is not coincidence, it's learning. Markets teach companies how far they can push, and companies listen very carefully. But here's the key part most people miss. This behavior is usually legal. Regulators look for explicit collusion, emails, phone calls, secret deals. But tacit collusion leaves no fingerprints. You can't arrest a pattern. You can't prosecute silence. As long as companies never agree in writing, they're safe. So the system rewards them. Executives who maintain industry discipline are praised. Stocks rise. Bonuses grow. Executives who break the pattern are punished. Their competitors respond. Margins collapse. Investors panic. And the message spreads fast. Don't be aggressive. Be predictable. This is why markets don't feel competitive anymore. Not because competition vanished, but because it became unnecessary. Now let's talk about the illusion of choice. Walk into a supermarket. You see hundreds of products, different brands, different packaging. But look closer. Many of those brands are owned by the same parent company. Different labels, same owner. This creates the feeling of choice without real competition. You think you're choosing between rivals, but you're choosing between siblings. This structure allows companies to control shelves, pricing, and perception. Even when smaller competitors exist, they're boxed in. They rely on the same suppliers, the same distributors, the same platforms. So they can't undercut prices too much. If they do, they get squeezed. Distribution dries up. Shelf space disappears. Advertising costs explode. The system quietly punishes rebellion. Now let's talk about innovation. We're told competition drives innovation. Sometimes it does, but in mature industries, innovation is risky. New ideas can fail. They can confuse customers. They can upset investors. So companies often innovate slowly, incrementally, just enough to justify higher prices, not enough to disrupt the system. This is why phones feel similar, why apps copy each other, why features arrive everywhere at once. Innovation becomes coordinated without coordination. Now you might wonder, why doesn't the government stop this? Sometimes it tries. Regulators investigate mergers. They impose fines. They issue warnings. But regulation is always behind the market. By the time a pattern is obvious, it's already normalized, and proving intent is hard. Companies defend themselves with data. They say costs increased. They say demand changed. They say consumers prefer it. And often they're partly right. That's what makes this system so powerful. It doesn't rely on lies. It relies on incentives. The market doesn't force companies to collude. It encourages them to avoid competition, and the results feel the same. So where does that leave us? As consumers, we feel squeezed. Prices rise. Quality stagnates. Choice feels fake. And frustration builds. But here's the uncomfortable truth. The system isn't broken. It's working exactly as designed. It rewards stability. It rewards scale. It rewards silence. And unless incentives change, behavior won't either. This doesn't mean competition is dead. It means it has moved. Real competition now comes from outsiders, new technologies, new business models, companies willing to lose money short term. That's why disruption looks violent. Ride-sharing attacked taxis, streaming attacked cable, online banking attacked traditional banks, not by playing the same game, but by changing the rules. And notice what happens next. Once disruptors become dominant, they start behaving the same way. Prices stabilize, innovation slows, margins become sacred.
The cycle repeats. So what can you do with this knowledge? First, stop blaming yourself. If prices feel unfair, it's not because you're bad with money. It's because the system limits your choices. Second, become more skeptical. When companies talk about competition, watch behavior, not words. Look at pricing patterns. Look at timing. And third, support real alternatives when they appear. Early competition is the only time consumers truly win. And finally, understand this. Big companies don't need to cheat to win. They just need to agree without agreeing. And that's why markets look competitive on the surface, but feel controlled underneath. Because competition didn't disappear, it just became inconvenient. And pretending is far more profitable.
Subscribe my channel for more interesting and informative videos. Thanks for watching.